For millennia, our world has been shaped by the movement of goods. From the dawn of civilization, trade has been the lifeblood of progress, a physical exchange of value that connected distant cultures and built empires. But how did the tangible goods our ancestors held in their hands, spices, silks, and grains, transform into the abstract financial instruments that now power the global economy? This is the story of how commodities evolved from physical goods into a complex financial asset class. Our story begins on the dusty trails of the ancient world. Imagine caravans laden with exotic spices and shimmering silks, traversing the vast expanse of the Silk Road. For centuries, trade was a direct, tangible affair. Merchants bartered and sold goods they could see and touch, their fortunes rising and falling with the success of each perilous journey. This was the age of physical commodities, where value was intrinsically tied to the utility and rarity of the goods themselves. The scent of cinnamon in a bustling marketplace or the feel of fine silk was the very essence of wealth, a direct link between a product and its price. The first seeds of a monumental change were sown in the fertile fields of the 19th century. As agriculture expanded, farmers faced a new kind of uncertainty. The price they could get for their harvest was at the mercy of weather, supply, and demand, making their livelihoods incredibly volatile. In bustling cities like Chicago, a revolutionary idea took root: the commodity exchange. Here, farmers and merchants began trading not the grain itself, but promises of future delivery at a set price. These were the first futures contracts, an ingenious tool designed to manage risk and bring stability to the agricultural market. For the first time, the value of a commodity was being separated from its physical form, traded as a concept on paper. This innovation set the stage for a full-blown financial revolution in the late 20th century. Wall Street's sharpest minds saw the potential in these markets, not just as a way to hedge agricultural risk, but as a fertile ground for speculation and investment. Hedge funds, institutional investors, and sophisticated traders began to pour into the commodity space. They weren't interested in taking delivery of barrels of oil or bushels of wheat. They were trading derivatives, complex financial instruments like options and swaps, whose value was derived from the price of the underlying commodity. The pits of the trading floors, once dominated by those with a direct connection to the physical goods, were now electrified by financial players who saw commodities as another asset to be traded, just like stocks and bonds. Today, we see the culmination of this evolution on the glowing screens of modern trading floors. The frantic shouting of the trading pits has been replaced by the silent hum of servers processing millions of trades a second. Commodities are now a vast, interconnected global asset class, represented by streams of digital data and intricate price charts. Their value is influenced not just by harvests and stockpiles, but by geopolitical events, monetary policy, and algorithmic trading strategies. The journey from a tangible good traded on an ancient road to a complex financial instrument in a digital world is a testament to human ingenuity and the relentless abstraction of value. What began as a simple exchange of physical goods has become an essential, yet often invisible, pillar of our modern financial system. The story of commodities is a mirror to our own economic evolution, reflecting a world where value is increasingly defined not by what we can hold, but by the data we can trade. And as we navigate this complex digital landscape, the echoes of those ancient caravans and bustling trading pits remind us of the tangible origins of the wealth that now flows invisibly around our planet.